Good, e- good evening, everyone.
Good evening, senior.
I hope we are doing well.
How was the day, senior?
Oh, media, I'm always fine. Oh.
That's good. That's good. I like the spirit.
All right. So last time we spoke about current tax. We spoke about under and what over provision, isn't it? All right. So we spoke about.
Yes.
This network should not come and worry you. So we are looking at IS12, which is taxes, and this standard has given us two forms of taxes. We have the current tax and we have what we call deferred tax. Deferred tax. So under the current tax, we spoke about the current tax the last time, where we have under provision and over provision. Hello, good evening. We have under provision and over provision. So we still take the under provision and then the over provision. What we have to know is sorry for that, my network is pulling. I just pray it should take us to wherever we are going. Okay. It should take us to wherever we are going. Okay, so I was saying that the IS12, which is taxes, give us two category or two types of tax. We have the current tax, and we also have what we call deferred tax. Okay, if you talk about current tax, what we are talking about is that if the company made a profit, the company made a profit of 2,000 for this year, and the tax rate is 25%, what will be the tax that they are going to pay? That particular tax that they will be paying on the current year's profit is what we call the current tax. So the tax payable on the current earnings of the company is what we call the current tax. Okay, what you have to know is that tax laws varies from countries to countries. Every country has its own tax laws. So there is no way we should have one way of accounting for taxes, because the tax law of Nigeria is different from the tax law of Ghana. And the tax law of Togo is different from the tax law of Ghana. So how they are going to do their tax accounting will be different, but there are going to be some similarities in how they are going to account for tax. That is what the standard is trying to address. What are some of the things that will cut across all companies that are dealing with tax in the whole world? That is what the standard is trying to address. The standard is not trying to prescribe a one way of accounting for tax to companies around the globe, no. But there might be similarities in how companies around the world account for taxes. That is what the standard is trying to regulate. Okay, so we are saying that the current tax is a tax payable or is a tax liability on the current earnings of the company. So if you made a profit of 2,000, the tax rate is 25%. If you apply the 25% on the 2,000, the amount that you get as a tax is what we call the current tax. Okay, but what normally happens is that the company will never know the tax that they are going to pay to the tax authority. The company will never know the amount of tax they are going to pay or the current tax they are going to pay for the current year before the year ends. There's no way they will know. It is after the financial year before the actual tax that they are going to pay to the tax authority will be known by them. So after the year, they will prepare their financial statement and submit it to the tax authority. The tax authority will now look at the financial statements and now disallow or allow some of the items based on the principles of necessity exclusively and those ones. So they will now disallow some of the items that are being expensed by the company and some of the things that are being capitalized or being treated as income. The tax authority will now use the tax law of that particular country to disallow and allow some of the items. So mostly what will happen is that the taxable profits or the chargeable profits or the taxable profits might not be the same as the accounting profits because of the allowing and the disallowing of some of the expenses or some of the items in the financial statements. So what normally happens is that the company, which is company A, will only know their actual tax liability, which is the current tax, will only know their actual tax liability when they have submitted the financial statement to the tax authority. So we can't be waiting. We are going to prepare financial statements and publish it. So we can't say that since we don't know the tax that we are going to pay for this year, we are going to wait for next year for the tax authority to give us the actual tax before we now come and include the tax in the financial statement. No. Since we are going to prepare an account for the year and publish it, the standard is saying that, or the tax law is saying that the companies should make what we call pre-tax assessment, or they have a name for it, that you are going to make an assessment, which is pre-assessment of your tax liability. So you can base your assessment or your estimate on past results. What was the tax that you paid last year? What was the profit? And what are you expecting? What is the increase that you are expecting in profits? So you can now base on your past performance and now make an estimate for the tax that you are going to pay. So what the company will do is that mostly the accountant will use tax estimates. They will use the available information to now make estimate for tax. So they will now put that figure in the financial statement, and at the end of the year, they will now give the financial statement to the tax authority to now assess it and give the company the actual tax that they are going to pay. So mostly what happens is that the company will make an estimate. The company will make an estimate of 20 million. But since we are making an estimate, there is a possibility of we overestimating and also we underestimating, because we are not using actual figure. We are just making an estimate. So since you are making an estimate, you are going to the market and you don't know the price of the item and you are making an estimate, you might end up underestimating or overestimating the price of that particular item. So what normally happens is that the entity is going to treat the 20 cedis as an estimate for tax, which will be the current tax in the statement of profit or loss. But maybe in the subsequent year, the tax authority will now give them the actual tax. So let's assume that the tax authority has given them the actual tax of 22 Ghana cedis. What is happening there? Our estimates were 20, and the tax authority is now giving them the actual tax of 22. What is happening?
There's been an increase in the tax.
Okay. So what
the
is the
tax?
what you can see that the actual tax that we should have charged should have been 22, isn't it?
Yes.
But we have charged 20. It means that we undercharged
20.
our what? Our tax liability or our current tax, we have undercharged it. So if there's a situation like this, we call something under provision. If the actual tax is higher than the estimate, then we say the company has underprovided for their tax liability. So we call this one under provision. But situation where the estimate is now 22 and the actual is now what? 20. The actual is now 20. What is happening here?
So there's been overprovision.
There has been an
Overprovision.
increase in this one. So that is what we call the over provision. Okay. But the question now is, how do we treat the under and then the over? We have to talk about the treatment now. So let's go to the treatment. Although we have spoken about this thing last week, but let's just finish everything today on tax. So the issue is the treatment. All right. Let's assume our profit for the year was 2,000 and our tax estimate was 200. What would be our profit after tax?
1,008.
1,008. Okay. But in the subsequent year, at the beginning of the current year, the tax authority has now given us actual tax liability or actual tax, or the company. The question will always say that the company has paid a tax of this one relating to the previous year. So tax paid is now 300. So assuming we knew the 300 from the beginning, what should have been our profits for the year? Assuming
1,007.
that would have been 1,007, isn't it? Okay.
Yeah.
Yes.
So it means that we have already published this account already. We are in the current year. It is in the current year that we know that the actual tax is 300. In actual sense, we should have gone and adjust our return earnings because profit for the last year will be in the opening return earnings. We should have gone there and adjust the return earnings by 100. So the return earnings will be having a profit for the last year, which is 1,008. Then we now bring the increase. So we now have 1,007. This is what we should have done in actual sense. But you also have to pay attention to one of the standards, which is the IS8, changes in accounting policy, estimate and errors. Okay, this is an estimate. This is an estimate. So when there is a change in an estimate, the change should be treated as what? Something which is going to have a prospective what? Effect. So if there is a change in an estimate, what we do is that the change will take effect from the current year. We don't go back and adjust the previous year financial statements. No, we will go and what? Adjust the current year statement with the estimate. So when there is a change in an estimate, it should take a prospective effect. So what we are going to do is that we won't go back and adjust our last year profit with 100. No, what we do is that we now charge this. This will be a reduction to the profit, isn't it? The 100 will be a reduction to the profit. Am I
Yes.
correct? Okay. So in the current year, what we do is that we subtract this from our what? Our current year profits. But the question now is, this year, we are still going to do estimate for the tax. So let's assume that this year, our profit is now 2,200. And our estimate for this year is now, 300. So under our normal circumstances, this will be 300. Then we now bring under provision, because the under provision should have been subtracted from the profit for the last year, but we didn't subtract it, so we have to come and subtract it from this year. So our profit for the year will be 1,800, isn't it?
Yes.
Okay. But the question now is, you can see that the tax and then the under provision over here, they are all relating to what? Tax, isn't it? So
Yes.
it will be better for us to now gross it and now have one figure for the tax. So look at this. What is the effect of the 100 on the profit? It's going to reduce the profit, isn't it? And our tax is also going to reduce the what? The profit. So under normal circumstance, our tax for the year should have been the current year estimate, which is 300. Then we now have the under provision to be 100 because they are all expenses. They are all going to be reducing the profit. You can see that this is now reducing the profit by 400. So add this and this. Since you are going to subtract, you add it. So instead of us doing it one by one, we now bring the 400 as the actual tax. What I'm trying to say is that whenever there is an under provision, it should be adjusted against the current year estimate. How do we adjust it? We add it to the current year estimate, because the under provision is going to reduce the profit and tax is also going to reduce the profit. So what we do is that we add the two and now go and use the whole figure, which is the one figure, to reduce our profits. So when there is an under provision, we add it to the current year estimate, which is the tax. Okay. Sometimes there will be something that the question will be saying about double entry. So let's look at a double entry. Sometimes they will not give you that the thing is under provision or over provision. They will give you that there was a debit balance on the tax account or there was a credit balance on the tax account. You have to determine whether it is under or over. Let's come here. Our estimates, let's assume that our estimate for the year is 200 cedis. Okay, so our actual tax that we pay, our actual tax is now 300. Okay, you see, this is an estimate that we are making, that we are going to pay this amount to the tax authority. So at the day that we are making the estimates, this is now a liability to us, because we are estimating that we are going to pay the tax authority 200 cedis. We are here to pay. So we are owing them 200 cedis. That will be a liability. That will be a liability to the company. So let's now have the tax account for the current year. So since this is a liability, what balance will this be having? What balance will this account be having? Debit or credit?
Credit.
Credit. So this is a liability. Balance brought down will be what? 200. Am I correct? Okay. Now you have paid, actual tax paid is 300. What will be the entry? If you pay, what is the double entry? You pay by cash or bank?
Your credit cash.
Debit.
Okay, so we now
Your credit, cash, and debit
the
tax
tax
sir.
account. So this will be 300, isn't it? All right. You see, the difference is not overpayment or something. This is the amount that we are paying for the tax. This is the actual amount that we should have paid for the tax for last year. So it's not overpayment or prepayment. No, this is the actual tax that you should have paid, but you are having 200. So what is going to happen here? What is going to happen? Which side is bigger?
The debit side.
Debit.
The debit side.
So we put balance what? Carry down here, isn't it?
Yes, sir.
Okay, that will be 100. All right, but we know that this balance carry down is representing what? Under provision, isn't it? The 100 is under provision because we should have paid 300, but we are making estimates, or we have 200 cedis in our account. It means that we have underestimated our tax. So this balance carry down over here is under provision. So, but since I don't want to put the under provision over here, I'm going to close these accounts and have something like this. So you see that the balance brought down will come here as what? 100, isn't it? All right. But the difference between these two is the under provision of what? 100. So sometimes the question will tell you that there was a debit balance of this on the tax account for last year. That should tell you that the debit balance over there is under provision. Or sometimes they will give you the tax figure in the trial balance and tell you that the tax figure over there represents under or over. You have to ask yourself, which side of the account is the tax figure found? Is it debit or credit? If it is debit, then you know that that is under provision. What if it is credit? Let's now count to over provision. Let's now count to over provision. Let's now count to over provision. So over provision, our estimate is now 500, and our actual tax is now 300. You can see that we are over providing for the tax, isn't it? You can see that we
Yes.
are over providing. So if you over provide for the tax, what will be the effect of the tax on the last year's profit? When we overestimate our tax, what will be the effect on the profit?
It will reduce our profit.
Okay, so if it is going to reduce our profit by 200, isn't it?
Yes.
So what do we have to go and do?
Add back.
Add back.
Okay. I'm also going to
You
give
add
you
it back.
another song. You see, you can see that tax is an expense, isn't it? Tax is an expense. So if
Yes, sir.
if you are underestimating your expense, it means that you are overestimating your profit. So treat the under provision as increase in an expense. Okay. Treat the under provision as increase in an expense. If there's an increase in an expense, what will happen? We go and subtract it from profit. So if the current tax is an expense and the under provision is also an expense, we put the two together. Okay. But let's assume now our profit for last year was 2,000 and our tax was 500. It means that our profit reported would have been what? 1,500 profit after tax. But in the current year, the tax authority has now given us a final tax payment of 300. So the final tax payment is 300 in respect of the 500. You can see that under normal circumstances, we should have subtracted what? 300 from the profits. But we have subtracted what? 500. So the 1,005, what we are going to do is that we have to go and add 200 back. But this is a change in an estimate. We don't adjust it prospectively. So what will happen is that, okay, this 200, don't go and do anything to your last year's profit, which is in retained earnings of 1,005. Don't go and add. The question now is this 200, what is the effect on the profit? This one will be treated as what? As an income. Just treat it as an income because you are saying that you are going to pay 500. Now it is what? 300. Your provision has reduced. So if the provision has reduced, what will happen? You have to go and add it back to your income. It will be treated as income, like normal provision. So if we are saying that we are going to pay the tax authority 700 for this year. Okay, if we are saying that we are going to pay them 700 for this year, our entry for that 700 will be like this. We have profit for this year, which will be 2,500. I'm just using assumed figures. Then we now have our tax of 700. Then we now add our over provision, which is the decrease 200. So we now have 2,000 as a profit. Am I correct with this figure? For the current year. All right. But look at this. You can see that this is a cost, isn't it? And this is income. You can see that in effect, we are only subtracting what? 500 from what? The 2,500. Can you see that?
Yes, sir.
Yes.
So what normally happens is that if there is over provision, the over provision is coming as income. It's coming as income. So if you are having your current tax estimate, the current tax estimate will be an expense. So go and net the income against the what? The expense. So if you have over provision, what we do is that we subtract the over provision from the current year's what? Estimate. That's what we do. All right. Let's count to the double. Yes, yeah.
Please, in this scenario, the 300, add back the over provision. It doesn't reflect the actual tax of 300.
No, the last year, what we are doing is that the tax was what? 500. That was our estimate, isn't it? And the tax authority has given us actual tax payment of 300. Okay. What we subtracted the tax from what? Our profit, isn't it? The tax
Yes, sir.
was subtracted from profit. But how much should have been the tax that we should subtract?
300.
300. But we subtracted what? 500.
500.
So what do we have to go and do? We have to go and add the 200 back, which is the difference.
Yes, sir.
Okay. But that 200 will not be added to the 1,005. We don't add it to the 1,005 because we have already closed the books for the previous year. We are now in the current year. It is in the current year that you are going to know this information about the actual tax. The actual tax to be paid will be given to you in the current year. So it is in the current year that we know. But we have into our mind that the 200 should have been added to profit. So if you count to the current year, your profit is now 2,500. Then you come and add your 200 to it, and you still make provision. You still make estimate for this year's tax, which is assumed to be 700. Which is assumed to be 700. So you have the profit for this year, which is 2,500, minus your current estimate for this year. Then you now
Okay.
add your over provision of 200. And I'm saying that you can
Okay,
see,
sir. I'm okay.
okay, you can see that in effect, we are subtracting only 500. So what we do when there's under or over provision is that we adjust the under or the over provision by the current year estimate. So you can see that this is an expense and this is an income. So we subtract the over provision from the current year estimates. That is what we do. That is what we do. But the current year estimate for every year will be treated as what? A current liability. Because that is the amount that you are presupposing that you are going to pay the tax authority. So in your books, that is the amount that you are owing the tax authority. So whenever you see current year estimate, treat it as a tax, as a current liability for that particular year. Whether you are adjusting it with under or over provision, treat the estimate because that is the amount that you are suggesting that you are going to pay the tax authority. So you treat it as a current liability, which is tax payable. And I'm saying that let's come to the T accounts for the tax payment for this year. So let's assume that this year tax was 2019. So we are in 2020 now. We are going to have our tax accounts. We are going to have our tax accounts, which will be balance drawdown of 500. The 500 was last year. So this will become opening balance for this year, which is 2020. Then we now have cash or bank, 300. Okay. What would the closing balance be? Which side, debit or credit?
Debit.
So you can see that we are going to have
Debit.
balance what carried down of 200. But this 200 is what? Over provision, isn't it? All right. So you have 500 here. Then you now have your 500 here. So for the year, you now have balance drawdown of 200, which is over provision. So the question can also say that there was a credit balance on the tax account for the previous year. So when the tax figure is on the credit side, and the question says that it represents under or over provision, the figure over there is over provision. But there can be so many cases where you see the tax figure on the credit or the debit side, but it will not be under or over provision. So we are going to look at whenever you see tax on the credit side, what is the meaning of that? What is the meaning of that? Or what can be other meaning to the tax on the debit side? So if you see tax on the debit side, what are some of the other things that that particular should be representing? Okay, if it is not under provision, it can be under provision. That is the first one. The first one can be under provision. The second one can be tax credit, where this will be treated as it will be treated as an asset. If the tax authority is owing you, then you are going to have credit for that. That will be an asset to you. So if it is an asset, it can be at the debit side of the trial balance. It can also represent tax expense. It can also represent tax expense or tax paid during the year or for the year. So if it is not tax expense, it can be tax paid. So if you pay tax, the double entry is that you credit cash or bank and debit the tax account. So if you are closing the balance, it means that the tax will be having a debit balance. Then you now bring it to the debit side. So whenever you see tax figure on the debit side, it can mean under provision. Mostly if you're doing final accounts, the question will say that the tax figure over there represent under or over provision concerning the previous year or for the previous year or for the year, they'll put the year there. If nothing is said like that, that can also be a tax credit, which is an asset, or it can be tax expense or tax paid for the year. If we see tax on the credit side, what would that also mean? If we see tax on the credit side, the first thing that it will represent is what? If you see tax on the credit side, the first thing that it will represent is what?
Overprovision.
Overprovision.
The first one is overprovision. Okay. The next one is what? The next one is what? The next one will be tax liability. It will be tax liability owings, which is a liability. That is the amount that you are owing the people. It can be tax liability. It can also be, I'm sure it will be only over provision, tax liability, and yes, or the tax liability can be tax owings. So it is either over provision or tax liability. But if you are doing final accounts, they will always state that the tax figure over there represents over or under provision for the subsequent or for the previous year. Okay, so we look at what we call under provision, what we call over provision. The current tax is only concerned about the companies overestimating their tax or underestimating their tax. And you can see that if companies in Nigeria are underestimating their tax and companies in Ghana are also underestimating their tax, it should be the same treatment. It should be the same treatment. If you're underestimating your tax, it means that you're underestimating your expenses. So what will be the effect? You go and subtract it back because you subtract less than you should have subtracted. And that will be the treatment for all the companies around the group. So that is the thing that the IS12 is trying to talk about for the current tax. If there's under provision and over provision, the treatment will be the same. You either overestimate your profits or underestimate your profits. And this is basic accounting. What are you going to do? You either add or subtract. So that's all about the current tax. You see that whenever you have a current tax estimate, that is the amount that the company is saying that they will be paying the tax authority in terms of tax. So at the date that they are making the estimate or at the reporting date, they are owing the tax authority this amount of money. So that should be treated as what? As a liability. So the current estimate for every year should be treated as a tax liability or a current liability for that particular year. But if you have under or over provision, the under or over provision should be adjusted against the current year estimate. Don't go and subtract it from the previous year's profits because the under or over provision represent a change in an estimate which should be treated what? Prospectively, or we should have a prospective effect on the statement of financial position. We also say that when you have a debit balance, they are saying that there was a debit balance in the tax accounts relating to the previous year. That will tell you that the company has underestimated the tax. So debit balance represents under provision, which should be added to the current year estimates, and credit balance represents what? Over provision, which should be subtracted from the current year estimates. Okay, that is all about the current tax. Let's now come to the second part of the tax.
Hello, sir.
Yes, now.
Please, with your tax account shown on the board, when we have the over provision, that also means that it's a tax liability or tax owings in the financial position.
If nothing was said, if they said that okay, if the company now agree, if these people, if the statement now says that the actual tax that the company should pay is the same as the estimates, if the question now says that the actual tax that the company is supposed to pay is the same as the estimate, which is the 500, but they have paid only 300, it means that they are still owing what? 200, isn't it? That would be a tax liability. But if the question says that the company has paid a final and the actual tax of 300 in respect for the previous year, which is 300, then this will tell you that the actual tax to be paid is 300, but you are saying that you are going to pay 500. So this is now over provision. So it depends on how the statement will be framed and be given to you.
Okay.
All right.
Okay. That's fine, sir.
Okay. Let's now look at the other side of the other part of the tax, which is the deferred tax. Okay. You see, as an accountant, don't take CV and say you are writing CV, or I say CV, PV. You are writing a payment voucher for deferred tax. No, nothing is deferred. But what we are trying to do is that we are just trying to make an estimate or make a provision for the future tax consequences of an event that is happening today. Okay, I will still take this one again. If you are accountant in an organization, you don't write a PV and say that you are going to pay deferred tax. No, nothing is deferred. Nothing is deferred. But what we are trying to do is that we are just trying to apply the concept of accrual concept or the accrual principle of accounting to make provision for something that is going to happen in the future. That's what we are doing. Okay. What you have to do is that, assuming the company has a plant which costs 20,000, you see that the company will be depreciating this item, isn't it? Will be depreciating this item every year. And the tax authority will also be giving a capital allowance in respect of what? The plant. Do you know that any non-current asset that a company is going to purchase, the tax authority will give them equivalent depreciation that we call capital allowance? Do you know that?
Yes.
Okay. So the question now is, the assumption is that the company is depreciating this asset using 20%. In the books, this is in the books of the company. This is a company. Okay. The tax authority. Okay. You see that the tax authority will also be having a plant at what will be the cost in the books of the tax authority. What will be the cost of the plant? It will still be the 20,000, isn't it? But they are now depreciating these assets at 25%. Okay, looking at these two different entities, which of them is going to exhaust the assets earlier?
B.
Tax authority.
The tax authority, isn't it? Okay. But what you have to know is that in the computation of the tax payable to the company, we use capital allowance, not the accounting depreciation. The tax authority will disallow the accounting depreciation and now give the company depreciation, which we call the capital allowance, based on their own format of giving it. Every tax authority has the format of giving. They have a way of giving this one. They have a applicable rate that they use for the items. Okay, so let's come here. Every year, what will be the depreciation for the company? What will be the depreciation for the company every year?
4,000.
That will be 4,000. Okay, but what will be the capital allowance that they will be giving to the company every year?
5,000.
5,000.
Okay, you can see that at the end of the fourth year, the tax authority is not going to give what? Capital allowance again in the fifth year, isn't it? The tax authority is not going to give what? Capital allowance in the fifth year. Can you say that they will not give capital allowance in the fifth year?
Yes,
Because
sir.
they are going to
Yes.
use the asset for 4 years. Okay. But what would a company be thinking about? They would think that in the fifth year, the tax authority is going to give them what? A capital allowance of what? 4,000, isn't it? you can see that they will be thinking that the tax authority is going to give them, capital allowance of what? 4,000. Okay, so as we are subtracting 4,000 from our profits, the tax authority is not going to give us any capital allowance on the profit in the 5th year. So it means that what is the effect of capital allowance on profits? What is the effect of capital allowance on the profits? And in terms of tax, what is the effect of capital allowance on the tax that the company is going to pay?
It will reduce your profits, thereby reducing your tax liability.
Okay, it will reduce your tax liability, isn't it? All right. So it means that in the 5th year, what is going to happen? In the 5th year, what is going to happen? The tax authority will charge 5,000 portion of what? The profit for the company, because that 5,000 will no longer be there. In the 5th year, the capital allowance will be given like this: year 1, year 2, and year 4. So year 1 will be 5,000, year 2 will be 5,000, year 3 will be 5,000, and year 4 will be what? 5,000. Year 5, it will be dashed. Whilst the company will be thinking that they are still going to have 5,000 at the end and what? Get capital allowance on it. So you see that in the 5th year, the capital allowance will not be given to the company again. The capital allowance will not be given to the company again. And in that case, the company or the portion that the tax allowance or the capital allowance will be reducing for the tax liability will not be reduced again. So the company is going to pay higher profit in the 5th year than any of the years. What is causing that higher tax? The company is going to pay a higher tax in the 5th year than any of the years. What is causing that particular higher tax? It is the earlier capital allowance that has been given to the company in the early years. It is the higher capital allowance that has been given to the company in the early years that is giving the higher tax liability. So if the company is making a profit of 20,000 every year, you see that in the first year, the company will pay tax on only 15,000. Second year will be 15,000. This year will also be 15,000. Fourth year will be 15,000. This year will be 15,000. But in the 5th year, the company will pay tax on what? All the what? 20,000. You can see that all the tax that the company has enjoyed will not be available in the 5th year. So the company is going to pay a higher tax in this particular year. So the question now is, these things has happened. The higher tax that we are paying today is as a result of an asset that we bought in a year ago, or in the 5th year, or in the first year. That is causing this. So what we do is that we look for the what? The tax that we are going to pay, the higher tax that we are going to pay in this year. What is the estimate of the tax, or what is the higher tax that we are going to pay if that capital allowance portion that we are getting for the tax authority is not there? What should have been the tax, and what would have been the effect? It is going to reduce our profit. So what we do is that we now make a provision for that particular tax that we are going to pay in the future when our capital allowance has been exhausted. That is what they are talking about as a deferred tax. That is what we are talking about as a deferred tax. So that I'll pick just 2 figures, then we look at the effect of the deferred tax, then we go to the deferred tax into details, and we see how far we can go about that. Okay, let's now count to 2020 and 2021. So let's assume that profit before tax for the company was 20,000 and was 20,000. Okay, and depreciation. Okay, let's assume that the cost of the asset was 4,000 and the company is depreciating this at 50%. So in the first year, they are charging a depreciation of 2,000, but the capital allowance given to them, the 2020, the tax authority is giving them 3,000, and 2021, the tax authority is giving them 1,000. The assumption is that the total value of the asset is 4,000 and the company is using 2 years. So every year the company, this is for the company. Every year the company will charge 2,000. 2,000. Okay. So let's assume that our profit will be, so profit before tax and depreciation. So this is, let me put it, profit before tax and depreciation. So our tax, let's assume our tax rate is 25%. What will be the tax payable on the profit for the 2 years?
4,500.
4,500. 4,500. Okay, let's now come to the books of the tax authority. Assuming all things being equal, the profit before depreciation was 20,000 for the first year, for 20,000. Then what will be the capital allowance now for the first year? In the books of the tax authority, that will be 3,000. Am I correct?
3,000.
Okay, and this will be 1,000. So what is going to happen here? Our profit will be 17,000, and our profit will be what? 19,000. What will be the tax payable? What will be the tax payable in the books of the tax authority? So the tax will be 25%. That'll give us how much? 2021.
4,250 for
4,000.
2020.
Okay.
We have 4,750 for 2021.
4,700 what?
50.
Okay. Look at this. What is our estimate? What is our tax estimate? 4,500, isn't it?
Yes.
But we are paying what? In actual sense, we are paying what?
4,250.
Okay. This is no over or under. This is as a result of the capital allowance, the difference in the capital allowance. Okay. So you can see that the company is in the early years, the company is what? Is enjoying, isn't it? The tax figure is going in their favor. It is going in their favor. It means that in the future, they are going to suffer. Let's come to this one. What is the tax amount in the books of the company? Based on accounting profits, what should be the tax? 4,500, isn't it?
Yes.
But what is the tax now?
4,750.
We are paying what? We are paying 250 in what? We are paying 250 in excess for 2021, isn't it?
Yes.
But you can see that it's this 250 that you have earlier enjoyed. That is why you have the 250 that you have enjoyed in 2020. That is the 250 that you are paying in 2021. Can you see that?
Yes.
Yes.
Okay. So what we are saying is that you see that this 250 that you are going to pay as an excess in 2021, make provision for it today. That is the deferred tax. So you can see that the differences. Look at this. What is the difference in the depreciation and capital allowance for the first year? Depreciation was what? 2,000. Capital allowance was what? 3,000. What is the difference? The difference is what?
1,000.
Okay. It means that the tax liability of the company is going to reduce by what? 1,000. Because the company is saying that their depreciation is 2,000. The tax authority is now saying that it's 3,000. It means that the tax that you are going to pay on this additional 1,000 will be saved for this year. But the next year, this 1,000 will not be there again. So you are going to pay you are going to pay tax on this. Let's find the tax on this particular amount. Let's find the tax figure on the 1,000. What are you getting?
250.
Okay.
250.
So you can see that the difference in the tax over here, which is 4,250 and 4,500 for the first year, is as a result of the excess capital allowance given to what? To the company. But the issue now is that excess 1,000 that they are enjoying now will not be available in the future, which they are going to subtract from their tax. So you can see that the excess 1,000 is not here. We only have 1,000. In this case, our profit is now what? increasing by what? Our tax liability is now increasing by 250. What is causing that 250? It is the company that is getting a more capital allowance in the previous years, and now they are getting a lower capital allowance. So you can see that at the end of the day, this will cancel. The company will pay because you enjoy 250, you are suffering 250. The company will be okay. But because this particular item over here, the 2,000 and 1,000 was given to the time, was in relating to the time that the asset was bought, we start making provision from the time that that difference is happening. We use the accrual concept. The assumption is that this extra 250 will be paid in the subsequent year. So since we know that we are going to pay it, let's make provision for that particular amount. That's what we do. That is a deferred tax. That is a deferred tax. So you can see that in the future, who is going to suffer? In the future, looking at this one, in the future, who is going to suffer? Is it the company or the tax authority? Is it the company or the tax authority?
Company will suffer.
The company will suffer. Since the company is going to suffer, it means that the company is going to, it will be a loss to the company. So this should be treated as expense. But if in the future it is the company that is going to enjoy, then the difference should be treated as what? An income or a tax credit. All right. So this is the idea about the deferred tax. But let's now come. There are two issues that can cause or that can create an issue of deferred tax. There are two issues that can cause what we call the deferred tax. Okay, the deferred tax, we are saying that there is an issue of a deferred tax because the taxable profit is different from the accounting profit. What might be causing that? The tax authority might be disallowing some of the items that are not qualified to be allowed for tax purposes, or the company and the tax authority might be treating an item that is allowable for tax purposes, but for different period. Okay, let's come here. You can see that the plants that we have taken, depreciation, and these ones that we have taken, you can see that this is going to take a longer period of time. The plant can be 50 years or something like that. So this is going to have effect, which is going to be for some number of years. But let's look at fines and penalties. Those who are doing taxation, you see, if you come to corporate tax liability, fines and penalties are not allowable for tax purposes because negligence before the law is not an excuse. So if you are driving recklessly and they fine you for, or they punish you for this traffic, some disobeying or something like that, and you pay penalties, the company will treat that as an expense. Maybe their driver is driving foolishly and there was a breach of the law and he has been fined. So the company is going to pay, and the company will treat that as what? As an expense. But if the company submit their books to the tax authority, you see the fines that you are paying was not a cost incurred to generate revenue for the company. No. So the tax authority is going to disallow that for tax purposes. So what will happen is that if our profit before the fines was 2,000, profit before the fines was 2,000, and the fines and penalty was 500, it means that the company will be saying that they are going to pay tax on 1,500. So they will apply the tax rate on it, 25%. But in the books of the tax authority, what they are going to do is that if the company is giving them a profit of 2,000, they will not subtract the 500 because the 500 is not an expense incurred to generate what? The 2,000 revenue. So the tax authority will now be charging their tax on this one. You can see that there will be a difference in the tax figure that the two people will be computing, isn't it? But these fines and penalties is going to happen just for that year. It will not happen continuously. it will not happen continuously. It will just happen within that year. If it happened within that year, then what will happen is that either the company will pay an extra tax or they'll get tax credit for that particular year. But if you come to capital allowance, you can see the capital allowance will be given for a number of years. If the asset is going to be lasting for 50 years, the tax authority might decide to give them a capital allowance for 20 years. So you can see that this particular one will be happening every year. But fines and penalty will be once in a year or once in a while. That is all. So the company either suffer the loss or they will pay for the tax or they will take tax credits. So if you come to deferred tax, there are two issues that you have to understand. The first one is what we call temporary differences. Temporary differences and permanent differences. Okay. I'll take the permanent differences first. You see, if you talk about permanent differences, we're talking about those items that are causing the difference between the accounting profit and the taxable profit. But these items are not allowable for tax purposes. There are items that are not allowable for tax purposes, but they are causing a difference between the accounting profit and then the taxable profits. So if these two happen, what will happen is that the company will either suffer additional tax or they will take tax credits in relation to that particular item. So there's one-off issue which will happen in a year, and that is the end. So those are what we call the permanent differences. If you say talk about permanent differences, we are talking about those items that are not allowable for tax purposes. But whenever they happen or they occur, they cause a difference between the accounting profits and then the taxable profits. Example of this is entertainment expenses. Entertainment expenses. The company do refreshment or engagement or end of year party. That end of year party is not an item that is being incurred necessarily to generate the revenue. No. So the company will subtract it from their profits as an expense, but the tax authority is going to disallow it. If this happens, you see that there will be a difference of this particular item being disallowed, which will be making the tax that the company is supposed to pay and the tax that the tax authority will be giving to the company to pay. It can also be fines and penalties. It can also be amortization of goodwill or impairment of goodwill, or whenever a company written a goodwill off, there will be a difference because the company will be treating this as an expense and the tax authority will not be treating this as an expense. So the taxable profits will be different from the accounting profits. But goodwill, tax authority doesn't give capital allowance on goodwill. So permanent differences are those items that are not allowable for tax purposes, but they do cause a difference between the accounting profits and the taxable profits. Whenever they happen, we don't make provision for them because they don't have any future tax consequences. They don't present any future tax consequences. They present only current tax consequences. So we don't make provision for permanent differences. But if it is capital allowance, which is going to be given over a number of years, you see that the tax consequences will be accumulating and have effect at the end of the useful life of the asset. So if the asset is going to last for 20 years, we are in the first year, you see that we have something in the future that we are going to pay for. So we make provision or deferred tax is only calculated on temporary differences. The temporary differences are caused by items that are allowable for tax purposes, but for different accounting periods. For different accounting periods. I'll say this. Whenever you are given a question, and the question says that the item is allowable for tax purposes, then you have to look for the implication or the deferred tax implication on that particular item. I might not be able to mention some of the items that will be causing temporary differences. But whenever the question says that this particular thing will be allowable for tax purposes or something like that, then you have to look for the deferred tax implication on that particular item. So if you talk about temporary differences, examples is depreciation. Depreciation of an asset, there can be a temporary difference when the tax authority is using a different rate and the company is also using a different rate. Or the company is using a different accounting method and the tax authority is using a different accounting method. The tax authority is using a different year and the company is using a different year. So the first one will be depreciation of non-current assets. It's one of the items, depreciation of non-current assets. It's one of the examples that bring issues about deferred tax or temporary differences. The next one is amortization or the capitalization of the next one is the capitalization of research, capitalization of research and development what? Research and development expenditure. You see, for the tax, what the tax law says is that if a corporate body like companies, they incur research and development expenditure, it should be written off against what? Profit in the time that it or in the year that it has been incurred. So what will happen is that if the company incur research and development expenditure of 50,000, the tax authority will give this one as an allowance for the year in which it has been what? Incurred. So they are going to allow all of this for tax purposes. What the company is doing is that the company will capitalize the research and development expenditure in accordance with IS 38 intangibles. So when they realize that the research and development expenditure is going to generate future cash flows, the company can actually get something from it. They will capitalize it in accordance with the IS 38 intangibles. So the company will capitalize this now, will capitalize the 50,000, and decide to amortize it over 5 years. So you see that in the first year in which this has been incurred, the tax liability of the company is going to reduce. But in the subsequent year, it will not be reduced because the tax authority will not be allowing the 50,000 for capital or for deduction again. So capitalized research and development expenditure will also cause an issue of deferred tax. Another one is upward or downwards valuation of the company's assets. Upward or downwards valuation of the company's assets. That will also create an issue of deferred tax, which we call revaluation surplus or revaluation gain. So in the books of the company, the plant is 50,000. In the books of the tax authority, the plant is also 50,000. But the company is using revaluation model for its property, plant, and equipment. The tax authority is not a company. They don't revalue the assets. They just carry the asset at cost. So whenever the company revalue the assets, you see that automatically the revaluation surplus will be causing a change in the carrying value of the asset. Although the company will not pay tax on the revaluation, but we as a company, we are looking at if we should pay tax on a revaluation amount, what should have been the tax consequences of that? So we try to find the tax implication on the revaluation surplus. So if the company revalue its assets, the revaluation will automatically make the carrying value of the assets higher than that of the tax base. Or the company will be saying that they will be getting more depreciation, whilst the tax authority will be giving them a lower depreciation. But what happened is that the revaluation, the deferred tax relating to the revaluation surplus will be taken to where we treat the revaluation surplus. So deferred tax on the revaluation will be sent to other comprehensive income. Another one is also impairment of inventory or loss on inventory. Okay, so the cost of the inventory was 20,000, but the company now sold the inventory for 15,000. What is happening? You can say the company is making a loss of what? The company will be making a loss of what? 5,000. And the tax authority will say that the loss on the inventory will be tax deductible whenever the inventory is sold. So you can see that whenever the inventory is sold, the company will be what? Will be suffering 5,000, but the tax authority will be giving them what? That 5,000. So the company will be taking the 5,000 for the loss. So whenever there is a loss, the company will be having what we call tax credits, because the company will be the one to enjoy. They are going to suffer now. So they will be giving an amount to cover the loss. So the company will now calculate the deferred tax on the loss. The question can also say the company is going to carry out a dismantling, which whenever it is incurred, the company is going to be allowed for tax purposes or something. So whenever they say the thing is allowable for tax purposes, it will always create a deferred tax implications. But let's come to the issues about the temporary differences. Let's come to this example. Okay, let's come to this example. We can see that the increase in the tax for 2021 was as a result of what? The 1,000 that the company has enjoyed in excess here. So mostly the standard says that we should calculate the deferred tax on the excess capital allowance that the tax authority is giving. So you can use the profit method, or you can use the liability method. So mostly we use the liability method. So if you want to calculate the excess 1,000 that the company is enjoying in excess, where they are going to pay tax on it in the future, we look at the carrying value of the assets. At the end of 2020, the carrying value of the asset will be 2,000, because it was 4,000 and they are charging a depreciation of 2,000. It will be 2,000. And the tax base of the asset in the books of the tax authority. If you say tax base, we are talking about carrying value in the books of the tax authority. The asset is 4,000 and the tax authority is giving 3,000 as a capital allowance. So the remaining balance will be 1,000. So what we do is that we find the difference between the carrying value and then the tax base, which will be 1,000. This is the excess amount, which can also be calculated as the capital allowance minus the depreciation. So we now apply the tax rate on this one and now have what we call the deferred tax liability. So the deferred tax can be two. It can be one that we call taxable, or the temporary difference can be two. It can be one that we call taxable temporary differences. Taxable temporary difference. Okay, when they say that the difference is taxable, it means that the company is going to pay a future tax on it. Therefore, it should be treated as an expense. So when do we have taxable temporary difference? We have a taxable temporary difference when the company is enjoying a higher capital allowance now as compared to their depreciation. So if you have a taxable temporary difference is when the carrying value of the assets, is greater than the tax base. The tax base is the carrying value of the asset in the books of the tax authority. So when the carrying value is greater than the tax base, we call something taxable temporary difference. The meaning is that the company is enjoying a higher capital allowance today, and they are going to suffer a future tax consequences on the excess capital allowance that they're enjoying today. So whenever the company is being given a capital allowance which is higher than the the depreciation, the difference will always be a taxable temporary difference. The next one is what we call deductible temporary difference. Deductible temporary difference. If you say deductible temporary difference, it means that the company is enjoying a lower capital allowance today in relation to their depreciation. The company is charging a higher depreciation. So at the time that the asset will be exhausted in their books, the tax authority will still be giving them additional capital allowance. The company will be enjoying additional capital allowance in the future, which will be a benefit to the company. So the deductible temporary difference is where the carrying value is less than the tax base, and this is treated as deferred tax assets because it is the company who is going to enjoy in the future. But if the company is being taken or the company is taking higher capital allowance today, it means that the company will be the one to suffer, whilst they are thinking that they will still have more capital allowance. So this will be treated as deferred tax liability. Deferred tax liability. So when we have a taxable temporary difference, we have what we call deferred tax liability. If it is deductible, it means that the company is charging a higher depreciation, thinking that the depreciation will not be available in the future, which they are going to subtract from their profit. But the tax authority will be giving them a capital allowance. So the company will still be enjoying the capital allowance. In that case, we call it a deferred tax asset. In whichever case, both will be treated as a long-term or a non-current item in the statement of financial position. If it is a deferred tax liability, this will happen over the useful life of the asset. So the asset is going to have 10 years. It means that the deferred tax will happen till 10 years. So that will be a long-term liability. So deferred tax liability is treated as non-current liability. Deferred tax asset is treated as non-current assets. But the question now is, how do we calculate deferred tax? How do we make the implication of the future tax consequences? We have done that already, where we look at 1,000 and multiply by 25 to get a 250, which is the excess here. So the deferred tax is calculated as a tax rate multiplied by the temporary difference. The temporary difference. How do we calculate the temporary difference? We calculate the temporary difference. Temporary difference is calculated using liability method, where we say carrying value minus the tax base. Where the carrying value is higher than the tax base, that is a taxable temporary difference, which should be treated as expense because the company is the one going to pay. So if they are going to be losing in the future, that will represent a cost. So we treat it as an expense today. You can also find the temporary difference using, you can also find the temporary difference using capital allowance and accounting depreciation for the year that you want to do. But the standard recommends the liability method, which is the carrying value minus the tax base. How do we find the carrying value? It is cost of the asset minus accumulated depreciation minus accumulated impairment losses. How do we find tax base? The tax base is the cost of the asset in the books of the tax authority minus the accumulated capital allowances. It's the same as carrying value, but just that it will be given. The depreciation is capital allowance, so we call it tax base. Tax base. Tax base. I don't have a question here, so that okay, I'll put a question together so that next 2 weeks we solve a question. So this is how we do the deferred tax. Deferred tax is calculated as, okay, so let me just put assumed figures over here. let's assume that the cost of the asset is 600,000. Okay, and the company depreciate the asset at a rate of 20%. But capital allowance is given at the rate of 30%. At the rate of 30%. So the question now is calculate the deferred tax for the year. Calculate the deferred tax. Let's just make it simple. Calculate the deferred tax. Okay. Okay. So looking at this example, what can you see? What can you notice about this example? You can see
The
that
the capital allowance percentage is higher than the depreciation.
So it means that the company is going to suffer future tax consequences because of the higher capital allowance today, isn't it?
Yes, sir.
Yes,
Okay.
sir.
So you have to, if they say calculate the deferred tax, the first thing that you have to do is that you have to look for the temporary what? Difference. We are not going to have a deferred tax implication when our depreciation is the same as what? Our capital allowance. We are not going to have any deferred tax in relation to the asset when the capital allowance rate is the same as the depreciation rate, because the temporary difference will be zero, because we are charging the same amount of capital allowance, the same amount as depreciation. Okay, but the first thing that you have to do is that you have to look for your temporary difference. How do we calculate the temporary difference? Temporary difference is calculated as what?
Carrying value minus
Carrying value minus what? The tax base.
tax base.
So let's now calculate our carrying value. Can we say the carrying value is 600,000 minus 0.2 times 600,000? Can we say that? Can we say 600,000 minus 0.2? Minus 0.2 times 600,000.
Yes.
Okay.
Yes, sir.
The depreciation is this amount. So if you subtract the depreciation from that figure, you get that. That will give us how much?
For 80.
480,000.
Yeah, 480.
Okay. Let's now count the tax base. The tax base will still be 600,000, which is the cost of the books in cost of the asset in the books of the tax authority, but they will now give capital allowance of 30%. What will be the tax base?
420,000.
100 and what?
20,000.
20,000.
Okay. So our temporary difference will now be what? 480,000 minus 420.
60,000.
60,000.
So this 60,000, is it taxable difference or deductible? Is it taxable or deductible? Taxable is where the carrying value is greater than the tax base. So in this case, what is happening? The carrying value is higher than the what?
It's higher than the tax base.
Okay. So whenever the tax base is lower than the carrying value, it means that the tax authority is giving a higher capital allowance to the company. The company is the one enjoying today. So in the future, that portion of the tax that they are enjoying today will not be available for them to subtract from their profit. So what we do is that our deferred tax is now, let's assume the tax rate is 25%. So 0.25 times what? 60,000.
15,000.
15,000. So this will be the deferred tax, which is supposed to be expense. But what we do is that we adjust it against our current tax. So we go and add it to the current tax. The deferred tax is treated as provision. So in the subsequent year, there might be increase or decrease in it. If there's decrease or increase, we know what to do. We'll talk about that one later. Okay. Can someone also tell me how we can also calculate the temporary difference without doing the carrying value and the tax base? You see, you have to be very creative.
If you subtract the depreciation percentage from the capital allowance percentage and multiply by the cost.
Yeah, tomorrow. So that is also another way of doing it. You can see that the excess will be what? The excess over here is the 10%. So the excess over here is the amount of the cost that the company is enjoying in excess. So you can find your temporary difference by having 0.1 times what? 600,000, which will give us what? 60,000. Then you multiply by 25%. In another way, if you find the depreciation and capital allowance, you will see that the capital allowance will be higher than the depreciation by 60,000. That is also another way of doing it. So you can calculate the depreciation and the capital allowance, then you will now find the difference. You will now find the difference. If the capital allowance is higher than the depreciation, that is a taxable temporary what? Difference. But if the depreciation is higher than the capital allowance, that will be a deductible temporary difference because the company is the one suffering. They are going to enjoy in the future. So if the capital allowance is higher than the depreciation, the company is the one enjoying because the tax authority is giving them more capital allowance. So they are the one enjoying. They are going to suffer in the future. So that should represent a cost or a loss to them. Just understand it like that, then we are good to go. So for the current year, we are going to have a deferred tax liability. Deferred tax liability of 15,000 in the statement of financial position. But since the company is going to pay this amount in 5 years or 4 years time, they are going to pay this because of the excess capital allowance that they're enjoying today. So we treat this as an expense in the profit or loss account by adding it to our current year estimate of tax. Okay. In the subsequent year, let's assume the deferred tax for this year is 2020. In the subsequent year, we can calculate the deferred tax, and the deferred tax will now be 12,000. Deferred tax will now be 12,000. What is the meaning of that? You calculate the deferred tax, and deferred tax will now be 12,000. What is happening to the deferred tax? In 2019, it was 15,000. 2020, it has
It's
what?
reducing.
Okay.
Reduce.
Don't say that the deferred tax has increased by 12,000. No. We are calculating the deferred tax on the same figures, temporary difference. So every deferred tax that you are going to calculate for a given year represent the total deferred tax for that year. So 2020 now, our deferred tax is now 12,000. This is the total deferred tax. But in the deferred tax account, what will be the opening balance for 2020?
15,000.
But the total now is what?
12,000.
So what is happening? Our provision is reducing, isn't it?
Yes.
If our provision is reducing, what happens to profit?
To increase.
So you go and subtract this from what? Your current tax estimate. So the increase in the provision in the deferred tax should be treated as an increase in any other provision. If you take provision for doubtful debts, if there is increase, we go and add the increase to the initial amount and treat the increase as an expense. If there is decrease, we subtract the decrease from the initial amount and treat the decrease as income. The same way applied to, or the same principle applies to the deferred tax. Deferred tax is a provision. So increase or decrease should be treated as any other provision. Are we there? Okay. That is for deferred tax. That is for deferred tax relating to profit or loss item. Okay. There can also be a situation where the company will not be using cost model, but the company will be using a revaluation model. So we are going to look at deferred tax relating to other comprehensive income item, which will be a revaluation, surplus or loss. Revaluation, surplus or loss. Wherever there is a revaluation surplus, the revaluation surplus will automatically increase the carrying value by that particular amount, which will not have effect on the tax base because the tax authority will be carrying the assets at their cost, less any accumulated capital allowances. So if there is any revaluation, the revaluation surplus will always increase the asset value by the revaluation surplus. So if that happens, assuming this asset that we have, the carrying value is 480, but at the end of the year, the company has revalued the asset. The company has revalued the asset to 520,000. You see that we are going to have a revaluation surplus of how much? Would that be 40,000? Would that be 40,000? The company has revalued the asset to, the carrying value was 480 at the end of the year. But at the end of the year, the company has revalued the asset to 520,000. There will be a revaluation surplus of what? 40,000. Am I correct?
Yes.
Yes, you are right.
But what will still be the tax base? The tax base will now be 420,000, isn't it? Okay. Let's now calculate our new temporary difference. Our new temporary difference will now be calculated as the carrying value, the new carrying value of the asset, which is the revalued amount. 520,000 minus what? 420,000. What is the new temporary difference now?
10,000. 10,000.
100,000 rather.
100,000. 100,000.
100,000. Sorry,
Okay.
100,000.
But you can see that this 100,000 is including the effect of what, a deferred tax, isn't it? It's including the
Yeah.
effect of the revaluation surplus. Okay. Assuming the asset was not revalued, our temporary difference should have been what? 60,000, isn't it?
Yes, sir.
Okay. But after the asset was revalued, we are now having an increase of what? 40,000. So whenever there was a revaluation and you have calculated the temporary difference for the total amount, including the revaluation, you now have to separate your temporary difference between profit and loss and revaluation. So if you come here, the temporary difference relating to profit and loss, you ask yourself, assuming the revaluation was not done, what should have been the carrying value of the assets? Then you compare with the tax base, because the tax base will not change. So assuming the revaluation was not done, our carrying value should have been 480, and this should have been 420, and that would be 60,000. But after it has been done, our temporary difference is now 100,000. Or if you look at the total one, just take your revaluation from it, because the difference will be the revaluation, because the tax base is not increasing. It's only the carrying value that will increase by the revaluation surplus. So you can just take your revaluation surplus for the 100,000 and now have the deferred tax relating to what? Profit or loss. And you count to other comprehensive income. Deferred tax that will be relating to this one. Then you now apply your tax rate on this, your tax rate on this. So when you have a question and there's a revaluation surplus in the question, try to depreciate the temporary difference that is relating to profit or loss, and that is relating to other comprehensive income. If you know your revaluation surplus, just take your revaluation surplus separately, calculate the deferred tax on it, which will be the deferred tax rate multiplied by the revaluation surplus, because the tax base for the revaluation will be zero. The tax authority doesn't revalue the asset. It means that the tax base for the revaluation will be zero. That of the company will be the revaluation surplus. So take the revaluation surplus for the total temporary difference and now do the one that will go to profit or loss and the one that will go to other comprehensive income. If there is a revaluation loss too, you do the same thing. If there's a revaluation loss, the loss is automatically going to reduce the tax, the temporary difference for the profit or loss by the revaluation loss. Assuming the revaluation was now 400,000. The revaluation was now 400,000. Okay, let me make it 460 because this was 480. Okay, the revaluation was now assuming the revaluation was now 440,000. Our new temporary difference will now be 440 minus this, which will give us 20,000. But the question now is, this 20,000 is not the actual temporary difference if the asset should not have been revalued. You can see that we are going to have a revaluation loss of 40,000. So this 40,000 has automatically reduced the original carrying value. So you ask yourself, assuming the revaluation was not done, what should be the carrying value of the asset? You do it, compare with your tax base, that is the temporary difference relating to the profit and loss, which will be added to the current year tax or subtracted from the current year tax. Okay, another way of doing this one also is that you calculate the total deferred tax on this. Let's calculate the total deferred tax on that and see. On the temporary difference, 0.25 times the 100,000. What are we getting?
25,000.
Okay.
25,000.
So that 25,000 is for both profit and loss and what? OCI. So what we do is that we now share it. Okay. What is the figure relating to profit and loss? It is 60,000. So 60 divided by the total times 25,000. Then OCI, you now have the 40 divided by the total times 25,000. Because the 25,000 was calculated on 100,000. So you now share them in a proportion like this. You'll be getting the same answer at the end. This will be 15,000 and this will be 10,000. If you like, you can multiply, you get the same answer at the end. So when there is a revaluation, the revaluation surplus will automatically increase the carrying value of the assets. So if you are given a total temporary difference, take your revaluation surplus from it, and the remaining temporary difference will be the one that is relating to profit or loss. Then you now calculate deferred tax on it, compare with the initial deferred tax balance that you have. Then you will now see whether there is an increase or there is an increase in the deferred tax amount or there is a decrease, which we call the movement in the deferred tax amount. So that is about the revaluation. The revaluation, the deferred tax implication will be taken to other comprehensive income because the revaluation surplus will be sent to other comprehensive income. But if it is a revaluation loss and there was no previous surplus relating to that, the company is going to have a tax credit because the value of the asset is reducing. So the company will now charge the tax rate on that because the revaluation loss will be treated in the profit or loss. The tax implication on that will also be sent to what? Profit or loss. Okay. Let's look at what we call relieved losses. Relieved losses. You see, the tax law is very friendly Yeah, it shows that it has been written. It's human who actually wrote the tax law. You see, there's some kind of humanity or humanity in the tax law. You see, if you are a new startup company and you start operating and you are making losses, the tax authority will allow you to take or to carry over these losses for a specific period of time. And this depends on the sector or the industry that you operate in. Because uh, some of the sector are called there's a name given to them. Those ones is it preferable or most preferable? There's one that will carry the losses.
Priority.
Okay, priority sector and those non-priority sector. Okay, so the priority sector and the non-priority sector. So some of the organizations, like if you're into cocoa processing and these ones, you are going to carry farming and those things, the number of years that you're going to carry your losses will be different from another one who is dealing in maybe import and export or something like that. Okay, so the tax authority is saying that, okay, you have started a business with money, and if you are making losses, we can't start accumulating the losses and say that whenever you make profit, we are going to tax you. No. If we know like that, you have made loss for 2 years, and then in the third year you have made a profit, and we are now taxing the profit that you have made, it means that we are not being fair. So the tax authority will allow the company to carry over their losses, But these losses, the tax authority will allow the company to subtract the losses from the profits in the order in which the losses was made. So if you have incurred losses for 2 years, in the third year you have made profits. If your profit can cover all your losses, then you write it off. If you cannot cover, then you write the first year's loss first. So the tax authority will not tax the profit that you are going to have in the next 3 years or in the next 4 years. They will allow you to subtract your losses. So the question now is, let's assume that the company made a loss of 50,000. Okay, and the company is saying that in the next 5 years, they can be able to make a profit of what? 30,000. So it means that in the next 5 years, the only part of the losses that they can subtract from the profit is what? In the next 5 years, what will be the part of the loss that they will subtract from the profit? The company is currently making a loss of 50,000, and they are saying that in the next 5 years, they are going to, so this is currently a loss of, they are currently making a loss of 50,000, and they are projecting that in the next 5 years, they are going to make a profit of 30,000. So what will be the portion of the loss that they will be able to subtract from the profit?
30,000.
30,000. In actual sense, the company should have paid what? Tax on the 30,000, isn't it?
Yes.
But they are not going to pay tax. So what is happening there? You can see that the company is having is enjoying tax benefits, isn't it?
Yeah.
Okay. So that tax benefit, you can see that we are enjoying that particular tax benefit as a result of the laws that we are incurring today, isn't it? So what we do is that we make provision for the benefit that we are going to enjoy in the future, which we call, who is going to enjoy the benefit? It's not the company.
Yes.
Okay. So since the company is the one going to enjoy, it seems like currently the tax authority is owing them a tax on the loss of 30,000. So the company will treat the deferred tax as a deferred tax asset. Whenever there is a loss, the deferred tax will be an asset, because it's the company who is going to enjoy the benefit in the future. But if you have a loss of 100,000, but you can only make a profit of 75,000, don't make the provision on all the losses. You can only make the provision on the amount of profit that you are sure that you are going to make in the future to cover the loss. If you are making a loss of 100,000, and the company is sure that, okay, in the next 5 years, they will make a profit of 150,000. It means that they can take all the loss from the profit, isn't it? They can
Yes.
take all the,
Yes.
so what will happen is that the deferred tax asset will be calculated on all the losses, because all the losses, the company will be able to make a profit, which all the losses can be written against. But if you have a loss of 150,000, and the company is saying that they can only make a profit of, they are saying that they can only make a profit. Who is enjoying like that? We can only make a profit of 100,000. Are we going to make the provision on all the 150,000?
No, please.
Why?
Because the profit we have can only cover for 100,000
Yes.
of
If you,
the loss.
yes. So if you are going to make for 150, would the 50,000 drop from the air? Will God send the 50,000 so that you go and write it again? So no, you can only make the provision, or you can only make a provision for deferred tax assets to the extent of the profit that the company is sure of making to cover the loss. So what we do is that the deferred tax asset is calculated as a tax rate multiplied by the losses that the company will be able to subtract from their future profits. That is how we calculate the deferred tax assets. So the deferred tax, we have a deferred tax for profit or loss where there will be a difference between capital allowance and the depreciation, amortization of research and development expenditure, something like that. Maybe next 2 weeks we pick a question and we look at that. We can also have a deferred tax on revaluation. We are comparing carrying value and tax base. The tax authority does not value the asset of the company, but the company is using revaluation model. It means that whenever they revalue the asset, the revaluation surplus will automatically increase the carrying value. So we have to, though we are not going to pay tax on the revaluation, but we are just saying that, okay, assuming we should pay tax, what should be the tax that we should pay on it? So we make the provision for the fair tax on the revaluation. We can also have a situation where the company is making losses. In the initial state, the company is making losses. The tax authority will allow the company to write these losses against their profit, against their future profit. So we have to make provision for the benefit, the tax benefit that we are going to enjoy in the future as a result of the unrelieved losses. We have losses that is called relieved losses and unrelieved losses. The relieved losses are losses that are already subtracted from profits. Unrelieved losses are the losses that are yet to be subtracted from the company's profits. So the provision will always be made on unrelieved losses. Let's talk about another issue. So for deferred tax is profit or loss, other comprehensive income, and losses. Let's talk about another issue, group accounts. Let's talk about specific application of the deferred tax. Okay, the first one is group accounts. The first one is the issue of goodwill. So group accounts. The issue of goodwill. Okay, when the parents acquire a subsidiary, what will happen? And the parent is paying higher than the consideration that the parent is paying is higher than the value of the asset that they are acquiring in the subsidiary. The difference, which is the intangible item which the parent is paying for, but we cannot see, is technically termed as goodwill.
Goodwill.
If there is a goodwill, what will happen to the asset of the subsidiary? The goodwill is going to increase the asset of the subsidiary, isn't it? Okay, but in the books of the tax authority, would the tax authority also add a goodwill to the asset of the subsidiary?
No, please.
No.
No. So you see that if you are calculating your temporary difference, you see that the goodwill figure will automatically be increasing the what? The temporary difference, isn't it? Okay, let me come here. Let's assume that the net asset of the company before the acquisition was 50,000. In the books of the tax authority was also 50,000. Now the company is adding a goodwill. Now the net asset is what? 55,000. The goodwill is now 5,000. So the net asset of the company will now be what? 55,000. Our temporary difference will now be what? 55,000 minus what? 50,000. And that will give us 5,000. What is costing the 5,000? What is costing the temporary difference of 5,000 is the goodwill, isn't it? All right. But the question
Yes.
now is goodwill deductible? Is goodwill allowable for tax purposes?
No, sir.
Is no, right?
Yes.
Okay. Therefore, the difference caused by the goodwill is a permanent what? Difference. So there's no deferred tax implication on the goodwill because goodwill is not allowable for tax purposes. So the difference caused over there is a permanent difference. And we don't consider permanent difference for deferred tax purposes. Okay, so the first one is be the goodwill, which will be included in the assets of the subsidiary. But the difference caused by the goodwill is a permanent difference. Therefore, there is no deferred tax implication. The next one is the fair value measurement of the subsidiary assets. Fair value measurement of the subsidiary assets. The standard says that at the date of acquisition, all the liabilities and assets of the company must be fair valued. Okay, so if there was a fair value or there's a fair value measurement, there are two things involved. Either the value of the assets will increase or the value of the asset will what? Will reduce. Okay, let's now say that at the date of acquisition, the net asset of the subsidiary was 150,000. All things being equal, the tax base at the date of acquisition was also 150,000. Okay, at acquisition date, they are now saying that the plant of the company has increased by 10,000 above its carrying value. What will be the new value of the net asset of the subsidiary? What will be the new value of the net asset of the subsidiary?
160,000.
160,000. Okay. So if you compare this with the tax base, what is happening?
It's higher than the tax base.
By how much? 10,000, isn't it?
10,000.
What is
Yes.
costing the 10,000? It is a fair value measurement, isn't it? All right.
Yes.
So at the date of acquisition, what you do is that the fair value measurement will now create a deferred tax at the date of acquisition. So you take your tax rate and multiply it by this. So if you are preparing your net asset table, you have your net asset, stated capital, and those ones. Then you count to deferred tax because the company will be having a deferred tax at acquisition of 2,500. That is a liability. So this will create a deferred tax implication or deferred tax liability at acquisition. So whenever there is a revaluation upwards, that revaluation will automatically increase the carrying value by the revaluation amount, whilst the tax base will still be the same. So you have to calculate a deferred tax implication on the revaluation amount. And as acquisition, if you're having a deferred tax at acquisition, it means that you're having a deferred tax liability, which should be subtracted from your net asset. But you see, all the console that you have been doing in financial reporting, you don't have issues like this. Okay, but the fair value measurement at acquisition will always create a deferred tax implication. Okay, It can also happen that the value of the asset has now reduced by 10,000 at acquisition. What will be the new value of the asset?
140,000.
140,000. And the difference will now be what? 10,000.
10,000.
This 10,000, there will be a deferred tax implication on the loss, isn't it?
Yes.
So you multiply by 0.25. This is a loss. Will it be treated as an asset or a liability?
A liability.
Hey, this is a loss. Oh. A loss. The tax authority is giving a tax on the loss that the company is suffering.
Okay, so it's to be an asset.
It will be an asset. So this, you are going to subtract this from your asset and now add this one as that particular issue. So fair value measurement will also create a deferred tax implication. Before we move on to the last one, I want to say something. Although we say land, which is freehold land, is not depreciable, but look at this. If the cost of land is 10,000 in the books of the company, it means that in the books of the tax authority, the cost of the land will also be what? 10,000, isn't it? Okay.
Yes.
Okay. Assuming the company is using revaluation model for the land, and they have now revalued the land to 15,000. You can see that over here, the temporary difference is what? 0, isn't it? Because there's no issue about capital allowance and depreciation. So the temporary difference will be 0. But if you come here now, what is the carrying value of the land?
15,000.
As compared to the tax base, is what?
It's the 5,000 difference.
The 5,000 is as a result of what? The revaluation. So you find the revaluation, the deferred tax implication of revaluation, and send it to other comprehensive income. So although land is not depreciable, we don't have any deferred tax issue concerning land in the profit or loss accounts. But we can have a deferred tax issue concerning land in the other comprehensive income when the land is being revalued upwards or downwards. You can see that if the value is increasing, it is the company that is going to pay the tax. So this will be an expense, will be subtracted from the revaluation surplus in the other comprehensive income. So have that in mind. Although land is not depreciable, whenever the land is valued, the revaluation surplus will increase the carrying value by that amount, while the tax base will still be the same. Let me take the next one under deferred tax in group accounts. Then we move on. The next one is unrealized profits. Unrealized what? Profit on inventory. Unrealized profit on inventory. You can see that if you are preparing group accounts, you just add the tax figures for the two companies. That is the end, isn't it? Those of you who have prepared group profit or loss account before, you see that if you are doing the consolidated financial statement, you just add the tax figures for the two companies. That is all, isn't it?
Yes.
What normally happens is that we are going to eliminate intra-group trading, where we assume that it's not that we assume the company cannot be selling to each other because the subsidiary is part of the parent. So how can you sell to yourselves? We assume that the parent is giving the goods to the subsidiary to sell to the general public on behalf of the parents. So at the end of the day, if you are giving your phone to someone or your friend to sell for you, at the end of the day, the amount of sales that your friend has made becomes the actual sales for you. You can't say that the value of the goods that you have sent to your friend is the actual sales. Your friend will sell and give and remit the money back to you. So the actual sales for your friend is now the actual sales for you. It's the same principle for the group. So what will happen is that at the time that the parent is selling to the subsidiary, the parent will recognize this in each separate financial statement as sale, where they will be having the total profit. The actual profit, they will assume that they are selling to a third party, where they are going to have the actual profit on the sale. but the person that they are giving the goods to is part of them. It's like a branch to them. So you can't be selling to your own branch. You are selling to the public through the branch. So if you send a goods there, at the end of the day, the sales that the branch has made in respect of the goods that you have sent is the actual sales for the group. So what we do is that the time that the parent was dispatching the goods, assuming the profit on the goods was what? 500. You see the tax figure in the parent's financial statement. The parent has taken into consideration the 500 profit before putting that tax figure there. So the 500 profit is actually part of the profit that the parent is estimating the tax on. So the tax that they are going to pay on this 500 profit is included in their tax liability or the tax rate or the tax expense in the statement of profit or loss. But right now we are saying that the actual sales, the actual profit made was 300. We have removed 200 what? Profit. We have removed 200 profit, which is the unrealized profit. If we are removing this profit, it means that this profit should have also gone with the what? The tax element, which is included in the what? In the tax expense of the parent or the subsidiary. But we don't do that. We just remove the unrealized profits. But the tax figure for the parent or the subsidiaries is including all the profit. They made the estimate based on all the profit that they are saying that they are going to make from the sale. Now, if you are removing the part of the profit, it means that the tax elements on that particular profit included in the tax expense should have also been removed from the tax expense because we haven't realized that portion of the profit. So we're supposed not to pay tax on that portion of the profit. But we don't do that. We just take the profit and just add the two tax. Meanwhile, the profit, the tax element, which is relating to the profit that we are here to realize, is part of the profit. We should have removed that, but we don't do it. So maybe if you are writing an exam and there was a tax rate there, you can apply the tax rate on the unrealized profit and come and take it from the tax expense. Or if the question says something like that, then you make adjustment for it. Or they can also bring this one as a theory question, which will be question 5 for corporate reporting or financial reporting, which will be 5 marks question. So they can ask you to explain the tax implication of the unrealized profit. The one who is selling the tax figure over there, they have made the estimate based on the entire profit on the goods that they have dispatched. So now we are removing the profit. It means that the tax element relating to that profit should have also been removed, but we don't do it. We don't do that. Okay. If there is also a transfer of PP, you can see that sometimes the subsidiary might not be having a certain asset, but the parent has an asset which is lying idle there. So the parent will decide to transfer it to the subsidiary. Sometimes the parent will assume that they are selling to the subsidiary, which cannot be the case. You are not using it and you send it to your other company to use it. It's just like you are the one using it through the company. So it should still be carried at the carrying value. But we normally carry it at a fair value where the company will be having, or the parent or the subsidiary will be having a profit of what? 5,000. So if you are consolidating, what we do is that we say that the asset should have been transferred at carrying value, not fair value. So we come and remove what? This particular gain. The time that the parent was calculating the profit, their profit, the gain was included. And the tax estimate was made on the total profit, which is including the gain. So if you are coming to remove the gain, then the tax element on this should also be removed from the tax, but we don't do that. So these are some of the deferred tax implications in the group accounts. Goodwill will bring it, but goodwill is a permanent difference. Revaluation, fair value measurement at acquisition will bring, because the revaluation will automatically increase the carrying value as compared to the tax base. So we make a provision, a deferred tax provision for the fair value adjustment upwards and downwards. And also the unrealized profits. The unrealized profits was because we are taking the tax expense for individual company. The one selling will recognize all the profits in individual statements and calculate tax on it. Since we are removing the profits, the tax elements relating to the profit should also have been removed, but we don't do it. So that is also an issue about a deferred tax there. Okay, ladies and gentlemen, this is all about deferred tax. We talk about current. This is all about IS-12 income taxes. It has current tax, which is the current tax payable on the taxable profits of the company. So if you are making a profit of 10,000 by the end of this year, the tax that you are going to pay on it is the current tax. In the case of the current tax, the companies are allowed, or the accountants are allowed to make an estimate, because they will never know the actual tax payable to the tax authority until they have submitted their financial statements to the tax authority. So they are allowed to make an estimate using maybe past information or their revenue level information about their revenue. It might happen that in the subsequent year, where the tax authority will take the financial statement of the company and do the computation, the actual tax payable might be higher or lower. So we have an issue of under provision or over provision, and we have spoken about how we treat that. We are saying that the under provision and over provision should not be adjusted against the previous earnings of the company. It should be treated as a change in an estimate, which is going to have a prospective effect. Then we come to deferred tax. We are saying that the deferred tax is not an issue of under provision or actual provision, or under provision or over provision. It's an issue caused by an item that is allowable for tax purposes, although the tax that we are estimating is the same, but just that there is an item that is causing the difference between the tax that the company is saying that they are going to pay and the tax that the tax authority is going to charge them. And we see that this difference can be in two types. We have the permanent, caused by items that are not allowable for tax purposes, and they are just like one-off items. So we don't make provision for deferred tax. There's no deferred tax implication. Example is fines and penalties, entertainment expense, and payment of goodwill. We also talk about temporary difference. Temporary difference, we say that they are items that are allowable for tax purposes, but for different periods. The treatment might be different. The first one is depreciation against capital allowance. The next one is amortization or capitalization of research and development expenditure. Another one is the upward or downward revision of the value of the asset. There can also be a loss on inventory. There can also be a cost that we are going to incur on dismantling of the asset. So whenever the question says that the item or the event or the item is allowable for tax purposes, whenever the company incurs it, you ask yourself, at the end of the day, who is going to enjoy or who is going to suffer? If the company is the one who is going to suffer in the year, that will be a loss. So it should be treated, the deferred tax should be treated as an expense. If it is the company who is going to enjoy, it means that the company is suffering. So they are going to enjoy. That should be treated as a deferred tax asset, which will be treated as a deferred tax credit, adjusted against the current year estimate. We say that deferred tax is a provision which is treated as any other provision. Decrease or increase should be treated as any other provision. We also look at the deferred tax implication of other comprehensive income where there's a revaluation surplus. And we are saying that whenever you are given a temporary difference, which is including revaluation surplus, take your revaluation surplus from it and know the temporary difference that is caused by profit and loss item. We also talk about relief or unrelieved losses, where the company is making losses in the initial stage, which the tax authority will allow the company to carry over those losses and subtract it from their profits. And we say that the losses that you are going to make the provision on, the deferred tax asset, should only be on the loss that the company is willing or the company is sure that they are going to make profit in the future to cover that portion of the loss. So it will be based on the loss that the company can be able to write against their future losses. We come to deferred tax implication of group account, where we say that there will be a difference in the net asset, which is caused by the goodwill, but the goodwill is a permanent, is a It's a permanent difference. It's an item that is not allowable for tax purposes. So there's no deferred tax implication. We spoke about fair value measurement at acquisition, which is going to increase the carrying value. So we should find a deferred tax implication on that. And also unrealized profit or transfer of an asset at profit or at a loss. Ladies and gentlemen, we have come to the end of income taxes. Any question? Any question? Seniors? Seniors, any question? Do you have any question? All right. So the silence means there's no question. But next week, which will be Tuesday, I'm not sure we can have a class. But the following one, we are going to solve questions on IS 12. We solve like maybe 3 questions or 4 questions. Then we start IS 36, which is impairment of assets. Impairment of assets. So I will share the questions with you maybe next week. But next week we won't have class. It will be the following week because I have some things to do. But I will share the questions with you, and we will solve the questions. But I will change it for the impairment. What we do is that we will be solving questions as we are moving on. So I will share the questions with you before we start the class. So as soon as we look at one thing, we solve one question, then an understanding will be there. Not that we treat the standards as a whole before we start solving questions. We solve the questions as we are moving. Okay, so I will start like that with the impairment. We will, as we are moving on, then we'll be solving questions on any item that we have taken from the standard. Not that we do everything and solve questions. That would be something that a lot of people might not be getting understanding. So we solve questions as we move on from the impairment. The next week, Tuesday, there won't be class. But the following one, we will solve questions on IS 12. If we don't have any...
But we have class on Monday and Saturday.
Yes, we have class on Monday and Saturday. Our Monday and Saturday class is still intense.
Okay.
All right. So this one, you see all the things that we are doing over here, we still do it in a normal class. But this one, I'm just doing it for anyone who wants to learn the standard. Even if you are not attending classes under us, you are still qualified to come and learn. So it's not for people who are undertaking teaching with us or people who are currently taking their tuition with us. No, it's for the general public. So if you know anyone who is writing corporate reporting and financial reporting, you can invite a person. It's free. Okay. All right.
Okay.
So if there is no question, we call it a night. And I'll see people on Saturday.